Yeah, inflation's been a big topic that I've been covering really for the past couple years, but of course, especially starting in 2020 when we saw this very large fiscal burst. And of course, it wasn't immediately inflationary, but my projection was that as we look out a period of time, that would start to become inflationary when economies reopened and when that money started to run into certain constraints. And so, we kind of see here in 2021 that some of those inflationary pressures have manifested. And it kind of started in some of the raw materials, right? So, most people are familiar with that huge lumber spike we had where you had a lot of people want to go and get, new homes, build new homes around the same time. And you had a constraint of how much sawmill capacity there was. But that was what I consider like a supply, like a shallow supply constraint, because if you look at, for example, timber, there was no shortage of timber. There was no price spike in timber, and specifically it was a sawmill capacity issue. And those sawmills smartly didn't want to do a ton of capex in response to a demand surge that they were pretty sure was not going to be, super long lasting. And so, you had that spike, and then that spike came back down. But we are seeing some deeper supply constraints happening as well. So the semiconductor shortage is an example of a deeper supply constraint in the sense if you look at where semiconductors are produced, almost all of them come out of Taiwan and South Korea. There's very little global dispersion of where semiconductor capacity is. It takes billions of dollars to bring a new foundry online. And when you think about, all the different semiconductor companies out there, it's kind of an illusion because a lot of those are fabless semiconductor companies where they do designs, but then they have one of the major companies like Taiwan Semi actually make it for them. And so it's actually only a kind of a handful of key companies that produce the vast majority of the semiconductors we can consume. And of course, they're in everything. They're in our cars. They're in our electronics. They're the new oil, you could say, of the 21st century. And so we have those semiconductor shortages, and that's trickling into the car market. And so if you look at the current kind of inflation spike we're seeing, actually a big chunk of that is the used automobiles that are spiking in value. And that's, of course, because there's new production that's constrained, so that brings some of the older cars to market at a higher price when people still have that demand for them. And then as we look out later this year, some of these other things could start to cool off. We're also going to have, harder base effects. So year-over-year comparisons, we're still comparing ourselves right now to that May and June period of last year, which was kind of a dip. So it kind of gives us some higher headline numbers. So those will get a little bit harder. But I think the next big thing we have to watch out for is rent price increases. So during this big inflationary spike, we've actually seen somewhat, lower inflation levels in rent. But as you kind of look out further, historically rent and owner's equivalent rent does follow housing prices with, say, an 18-month lag. And so we've had this big surge in housing prices, and we're starting to see signs that rent inflation is picking up. And so I think as we go into the autumn, that's probably the next big round to look for.
Lyn, I really like the points you make because I agree with them. So it really helps validate my views when somebody like you comes in and substantiates and validates and agrees with me. You talk about a lot of factors. The big argument right now is transitory or sticky, and really it's more complicated than that. One of the things I tell people is there are a lot of factors right now that are transitory, and you can't ignore that. But the other factors that are sticky are even more than sticky. They're virtually permanent. You talk about wage increases; those are virtually impossible to get back. So they're going to be there and establish a higher plateau going forward. You talk about things like copper and other commodities and base metals. Those take, if not years, then decades. And in the case of copper, we have such a high, a steep demand growth curve ahead that it may be decades before copper can ever catch up to the growth in demand. And rents are notoriously slow to come back if they can ever be. So all of these not only establish a higher level or plateau for inflation, so we may not have the higher inflation rates, but we will have much higher prices. A lot of these impact markets downstream, copper in particular, wages in particular. Where do you see those effects for taking kind of a mixed bag right now, but a lot of the higher prices we're seeing will impact other products down the line?
Yeah, it's a good question, and I agree. So we have transitory components, and then we have these more structural components. And so over the past 25 years, we've been in this really big disinflationary trend of, say, outsourcing and automating a lot of our labor, and we're starting to see kind of that pendulum kind of start to reverse. There's political realities, there's national security realities. You can only outsource so much of your manufacturing base before you start to run into some issues of doing that. And so there's kind of more of a trend towards stopping that outsourcing, maybe bring some of it back. We also, of course, have these labor shortages that are currently happening, especially in some of the lower paying or service oriented fields like restaurants. And so that all represents kind of more longer term wage pressure, kind of a longer term floor on inflation. Whereas, yes, some of these commodities were more cyclical. Now, one thing I'm looking at is the copper to gold ratio. And so if you look at that over the past 30 years, there's a big burst of copper, during the China boom about a decade ago. But other than that one period, you have almost like a sine wave between gold and copper. It's one of the cleanest kind of cyclical charts that kind of lines up with these. Say you have 18 months of growth in the world, and you have like 18 months of slowing down, and you have another 18 months of growth, and then so you kind of go through these like say 3-year cycles. And over the past 18 months or so, a little bit less, we've been in this period of time where copper has outperformed gold from that spring or spring and summer 2020 period, because that's where we've had all the fiscal responses. Then you had the vaccines, the partial reopenings, kind of rolling reopenings and rolling lockdowns around the world. But basically, you kind of came out of that big trough, and so we've had copper outperforming gold. And so, copper investors have been very happy. Gold investors have been kind of, lackluster in this period. But we're starting to see signs that ratio is topping out to some extent, and that it seems to be swinging a little bit back into gold's favor. And I think that makes sense because we're also seeing, for example, that in many countries the fiscal stimulus is not at the same rate that it was, say, a year ago or 6 months ago, right? So if you look at, in the United States, we had these rounds of stimulus checks, we had these rounds of PPP loans turned into grants, we had extra unemployment benefits. And so there's still some aspects of that. There's still child tax credits and things like that. But some of those initial big bursts of helicopter money essentially are behind us. And I think, in the future, we'll see probably more rounds of those types of activities. I think we can see infrastructure. I think, in the next, if say you have enough of a downturn, I think you can see more rounds of the stimulus checks. But at least in this period of time, we have somewhat like a slower kind of disbursement of those sort of things. And so I think we could, have that cool off a little bit, and some of these more defensive assets like gold start to do pretty well. And you could have a weaker demand for some of these other types of more cyclical commodities. And of course, oil is the big wild card because, we on one hand, you have these rolling lockdowns are affecting demand for it, right? So the whole Delta variant thing, you have Australia locking down a bunch of their cities. And so that sort of thing can reduce oil demand. And we also see that OPEC still has some spare capacity. But on the other hand, the longer term story there is that we have a lot of supply destruction. And so in the United States, for example, a lot of those wells have to be replaced with new capex at a pretty aggressive rate. Otherwise, you have reduced supply. And, we're not basically globally, you don't see a lot of companies put heavy money into capex to find new reserves, which makes sense because oil price has been pretty sluggish for the past 6-7 years, and we've been in this period of oversupply. So I think as you look out a couple of years, I think another driver of inflation could be we actually run into a pretty tight oil market that we haven't really seen since the decade of the 2000s, right? So before the whole global financial crisis.